एक ही दिन में 2 लाख करोड़ रुपए साफ. Welcome to Himalayan Stocks Gurukul. Today we are breaking down the crude oil bomb that just hit the Indian markets. The 24,000 mark on the Nifty 50 acted like an electric fence. This bearish engulfing candle shows the exact moment late buyers were trapped as the index collapsed 118 points. Geopolitical escalation provided the trigger. US strikes in southern Iran and a multi-front conflict involving Hezbollah sent Brent crude spiking toward $99. As the markets bleed, many traders are left paralyzed. The immediate question for May 27th is whether you should liquidate your holdings or prepare to buy a significant dip. Focusing strictly on the 2 lakh crore rupee headline is a distraction. The primary risk factor is the $99 crude ceiling, which is forcing a structural repricing of risk across all import-heavy sectors. However, there is a massive divergence happening. While the Frontline Nifty index was bleeding, the Nifty Midcap 100 actually climbed to a new historic all-time high. This midcap strength suggests that domestic liquidity is still betting on the internal India growth story, choosing to ignore the global noise for now. This chart highlights a second anomaly. Even as the Nifty fell, the India VIX dropped to 16.13, showing option writers have little fear. This is a warning sign. Historically, a VIX dropping below 15 during a sell-off often precedes a significant volatility explosion. With midcaps at highs and the VIX collapsing during a crash, the market is sending conflicting messages. This makes traditional dip buying dangerous without very specific technical limits. Strategist David Roche is warning that strategic petroleum reserves are largely a myth. He projects that reserves in Europe and parts of Asia could be exhausted by September. If these reserves run low, oil prices are likely to remain above the $95 mark for much longer than the current consensus suggests. The impact on the Indian economy is immediate. The crude spike caused the rupee to crash 45 paise, reaching 95.68 against the dollar. This matrix shows the clear divide. High oil and weak currency squeeze importers, crushing margins for paint, aviation, and oil marketing. Conversely, IT and pharma exporters receive a sudden premium as dollar earnings convert to more rupees. Global sentiment is also helping. US tech futures are hitting record highs on AI demand, which provides a significant tailwind for India's major IT giants. This macro environment requires a portfolio shift. The logical move is to reduce exposure in import-heavy sectors and look toward those benefiting from export premiums. There is a growing risk in domestic portfolios, as the recent rally in public sector undertakings show signs of exhaustion. This chart shows the 59% collapse in year-over-year profits for Rail Vikas Nigam. This sharp decline in a market favorite suggests that valuations in some PSU stocks have disconnected from their earnings. We see similar weakness in logistics. Container Corp's 12% profit drop highlights a cooling in demand that challenges the broader trade recovery thesis. Index heavyweights are also under pressure. HDFC Bank, Titan, and TCS acted as anchors, pulling the Sensex down nearly 500 points in a single session. Relative rotation graphs show a clear trend. While PSU banks are moving into the lagging quadrant, private banks are beginning to lead the recovery as smart money shifts its focus. Holding on to overextended PSUs or sluggish heavyweights currently risks tying up capital in assets that lack immediate growth catalysts. While some sectors struggle, others are thriving by capturing specific themes that are currently defying the global sell-off. The capital expenditure cycle remains active. Industrial leaders like Schneider Infra and Polycab hit fresh 52-week highs, driven by domestic electrification projects. A new strategic framework between the Quad nations, the US, India, Japan, and Australia, is aiming to diversify the global supply of rare earth minerals. This geopolitical shift caused GMDC shares to surge 5%. The stock is now a central player in the race for strategic mineral independence. The Adani Group also shows resilience. Adani Enterprises and Adani Power reached 52-week peaks, decoupling from the broader index through infrastructure and energy plays. In the defense space, Balu Forge surged 7% following an aerospace order from a US firm, marking a successful move into high-precision manufacturing. Finally, investors are using FMCG as a defensive shield. Nestle and HUL stayed in the green as the market sought the relative safety of consumption staples during war escalations. Institutional capital is not exiting the market, it is rotating. Money is moving away from old economy PSUs and into defense, Capex, and strategic mineral stocks. Let's break down the critical technical levels for the May 27th session, starting with the specific outlook for intraday traders. FNO data shows heavy open interest at 24,000. It acts as a magnet for expiry settlement. The critical level to watch is 23,800, the final line of defense and the only safe zone for a buy-on-dip strategy. Use Brent crude as your final signal. If oil sustains above $99, avoid long positions. If it begins to cool, look for a potential bounce back toward 24,050. Success for intraday traders on May 27th depends on following these technical levels strictly, rather than reacting to the emotional swings of the market. For long-term investors, the focus must remain on the structural shifts in the market, rather than daily index movements. The strategy is clear. Use any temporary recovery to liquidate underperforming PSUs and index heavyweights. On the buy side, accumulate FMCG for balance, and add midcaps or GMDC during panic for long-term growth. The final Himalayan stocks Geopolitical verdict for May 27th is that the bull is wounded but not dead. The current strategy is to sell on the rise and buy on the panic. Using the Himalayan fractional investment model is the most effective way to navigate these global shocks and stay on the path toward financial freedom. Discipline wins wars, not bravery. If you found this analysis helpful, please subscribe, like, and share the channel. This is Himalayan Stocks Geopolitical.